Thanks for joining me this Friday, the 17th of October. I'm Grady, Senior Market Analyst with Bell Direct, and this is our weekly market update. Well, market volatility was once again heightened this past trading week as social media posts and renewed trade war concerns between the world's two largest economies in China and the US reignited fears of global trade tensions disrupting economic growth and stability on a broad scale. Markets had their worst day in months to start the new trading week after President Trump took to Truth Social to say massive increases in tariffs are coming for China on Friday last week, which naturally sparked fear and a selling frenzy among investors to start this new trading week. He took to this social media platform once again on Monday, though, to say all will be fine, a contradictory and strategic move, some would argue, which naturally led to markets rallying to start the new trading week. By midweek, however, any hopes of a de-escalation were dashed. China's Ministry of Commerce retaliated against the US by sanctioning 5 US-related entities connected to Hanwha Marine Corporation, escalating the dispute and sending a clear signal that Beijing would not remain passive amid ongoing US investigations into the maritime and logistics sectors in China. The situation further deteriorated when Trump floated the idea of halting US imports of Chinese cooking oil. Yes, a very niche threat that nonetheless still rattled sectors tied to consumer goods and trade, driving up prices in related US domestic stocks of cooking oil this week. So where does this trade war stand? What will it take to reach a conclusion? And what does this mean for you as an investor? For a meaningful resolution to be reached, both sides will need to commit to a more stable and predictable negotiation path, no longer on social media. One grounded in clear economic objectives rather than reactive and retaliatory political posturing. Until that happens, trade policy will likely continue to be used as a strategic lever in both countries' broader geopolitical agendas. This means headline risk, the sudden market movements sparked by news or social posts, will remain a persistent feature of the investment landscape until a material deal is agreed upon. As an investor, this environment demands heightened awareness and flexibility in approach. Exposures to sectors heavily reliant on global trade, such as industrials, commodities, and semiconductors, may need to be reassessed in favour of more domestically driven or defensive plays. Additionally, the possibility of sustained tariffs could benefit some US industries by making Chinese alternatives less competitive, as we've seen in the spike in domestic cooking oil-related stocks just this week. Ultimately, navigating the ongoing US-China trade conflict requires both caution and agility, and the focus on diversification with a keen eye on policy developments that can reshape market dynamics for overnight. For ASX-listed stocks, the ongoing US-China trade war introduces a layer of uncertainty that can significantly impact market performance, particularly for companies with direct exposure to the global trade theme or those reliant on demand from China. Resource and mining companies, which form a large part of the ASX, could see some volatility in commodity prices influenced by shifts in Chinese industrial activity or retaliatory tariffs. Similarly, Australian exporters and manufacturers that depend on Chinese market may face headwinds in trade barriers escalating, and if they do. Conversely, some sectors such as domestic-focused businesses or companies in alternative markets might benefit from supply chain diversifications or shifts in trade flows. Overall, the trade war heightening and markets risk on the ASX, this underscores the importance of closely monitoring geopolitical developments and their potential ripple effects on Australian equities. So keep this in mind. Locally, from Monday to Thursday, the ASX 200 posted a 1.1% rise, buoyed by strength among healthcare, real estate and materials stocks, or the gold rally, while tech stocks came under pressure with a 1.35% decline over the trading week. The winning stocks were led by Deep Yellow, soaring 22.39%, so the uranium producer there, while AMP added 14.37% and Genesis Minerals ended the week up 12.74%. While on the losing end, DroneShield continued its tumble of late with a tumble of 24.85%. Austal fell 11.53% and Capstone Copper Corp ended the week down just shy of 9%. On the broader market index, the All Ords posted a 1.07% rise as Bougainville copper rocketed over 155% despite no news out to the market, while Lavoto Resources jumped almost 50%. EOS and Elsite dropped over 32% and 30% respectively at the other end of the market this week. The most traded stocks by Bell Direct clients this trading week were Arafura Rare Earths and Newmont Corporation. Clients also bought into CSL while taking profits from CBA, Lynas Rare Earths, BHP, Macquarie Group, Drone Shield, Dateline Resources and ANZ, so quite a lot of selling this week. And the most traded ETFs by our clients this week were led by iShares S&P 500 AUD ETF, Vanguard Australian Shares Index ETF, and Global X Physical Silver ETF. Next week on the economic calendar front, we may see investors respond to GDP growth rate data, industrial production and retail sales data out of China on Monday, while the key US inflation, durable goods orders and existing home sales data is also out next week, which will give investors an insight into how the world's two largest economies are faring so far in 2025. And that's all for this trading week and this weekend. I hope you have a wonderful weekend and happy investing.